Good morning, everyone, and welcome to another installment of the Prosperity Through Multifamily Real Estate Investing Podcast. I am your host, Real Estate Cody, and with me, as always, is the coffee connoisseur himself, Mr. Brian Alfaro. Brian, good morning. How are you?
Good morning, Cody. Nice to see you. We got some exciting guests today. Looking forward to being here.
Yeah, man. Always excited to bring on another great group of guests on today and talking about, really an asset class that we love and a strategy that we really love right now. So, why don't you tell the listeners who we are talking to today?
All right. Today, I would like to welcome Ryan Webster and Warren Dresner to the show. They are from Equity Yield Group, and Equity Yield Group is a real estate investment firm specializing in institutional grade A and B class multifamily assets in great markets, source qualified and managed by an experienced team. They have a strong track record of delivering results to their investors, and they have high standards to focus on quality, and they also invest right alongside their investors. Ryan is an award-winning home builder, experienced real estate professional and entrepreneur. He has over a decade of experience owning and operating a Midwest-based construction and development company, and has done a wide range of has a wide range of project experience managing new construction and value-add multifamily projects as well. Warren has over 20 years of experience in finance, insurance, and real estate in the US, UK, and Australia. He also has experience investing in both single family homes and, of course, multifamily apartments, and has currently invested in over 2,000 units across the Southeast and Midwest. Welcome to the show, Ryan and Warren.
Thanks for having us. Good to be here.
Thank you.
Awesome, guys. Well, it's great to have you here. Really looking forward to learning more about you guys over at Equity Yield. And, let's start from there. Tell us a little bit more about, your respective backgrounds, how you guys formed Equity Yield, and then we'll go from there.
Yeah, absolutely. I think Brian kind of hit the highlights. My background's obviously in construction and been in the real estate industry in one form or another for a very long time. I got hooked up with Warren a couple of years ago and kind of talking through, investing in multifamily. We happened to be hunting for similar products in the same markets and started a discussion of, hey, what's a good investment to you? Where do you think quality is? Where do you think value is? And there was some kind of alignment in our investment thesis. And then we started working together and formed Equity Yield Group.
I guess my background's a little different. As Brian described, I've got a background in corporate, in finance. So I've always been numbers driven. I got into real estate originally more as a side hustle, buying single family homes, looking for tax advantages and also a bit of passive income. Slowly over time, I realized it was a lot of work. It wasn't so passive to be owning these single family homes. So I started investing in syndications passively. And then from there, really loved the industry and started to get more involved actively. We talk about our thesis looking for these newer assets, which we consider to be lower risk investments. It's kind of been driven out of a combination of Ryan's background and my background. With his construction view, he's looking at the risk from a construction point of view, knowing that there's less deferred maintenance on these assets. We also know that the demographic tends to be better in these apartment buildings. They tend to be built in better suburbs, better locations, better submarkets. And then as a passive investor as well, my background, looking at as an investor standpoint, we really try and just provide great service to our investors, great communication, because we've both noticed that not all syndicators communicate well. Not all investors get a great experience in syndications. So we're looking at quality assets, but also quality operations and quality communication. And that's really a summary of how we're approaching the business.
Yeah, appreciate that summary, guys. And I know it's very refreshing to have this kind of conversation because, again, as we were talking about before the show, Brian and I, our third partner, John at Blue Capital, that is our thesis as well. And investing in not only quality assets and quality markets, but also just trying to push the envelope when it comes to enhancing customer service, which, that is a huge component of what we do in investor relations, right, Brian?
Yeah, it's the little things that matter. When people think about customer service, they don't they try to overcomplicate it. It's just being available, being active, being proactive in communicating with your investors. it goes a long way because as you guys mentioned, not a lot of people are doing those little things, and that's really what makes the difference for somebody as the full life cycle of the deal. What was their experience like? What type of flavor did you leave in their mouth, so to speak? Did they have a good feeling, or do they have bad feelings when they think about you? You want to make sure they always have good feelings.
Yeah, absolutely. Because at the end of the day, the investor is, they're not just the customer. They're also partners. We couldn't run the business without them, and as a partner in these properties, they deserve to be treated as such and have the transparent communication and access to the people managing the deal.
Yeah, I completely agree, Ryan. Definitely agree. I want to continue to expand on that a little bit later, but I actually would like to kind of pull back and get focused on, your investing thesis and the strategy around focusing on institutional quality assets. And, I think this has kind of been a recurring theme for us over the last, call it 24 months, where we've seen this accelerated asset valuations across all asset classes. You've seen yields shrink across all asset classes. And I know for Brian and I, we made that pivot from looking at, the value add type plays, moving into more of your stabilized, newer quality product for that same reason, because you're buying everything on a premium, right? So there's much more execution risk, a tighter yield, metric. And so, the question is like, well, how do we get into an offering and give our investors an opportunity that is sound in its fundamentals, that can protect their capital, give them a solid yield without those certain risk exposures that we've been experiencing in the market. So talk to us a little bit more about kind of what drove you guys to make that transition or focus on A-class quality assets.
Yeah, I guess we never really transitioned there. That's just where we naturally started. And Warren kind of summarized it early. It started with firstly my experience in working on older properties over the years and the headaches that come with that. And we do like value add and the ability to force appreciation, but that doesn't mean you need to buy something built in 1964 and put 20K a unit into it. Because that particular property is going to come with a ton of unforeseen costs, a lot of execution risk on the construction side. And we're in an environment where, skilled trade labor is in short supply. So the cost of labor is going up. The cost of materials is going up. The availability and ability to get materials to the job site is going up. So if you're trying to run a very heavy lift project, there's a ton of execution risk. And it doesn't take too many missteps before it eats into the projected returns there. So we knew we wanted to stay away from that. And the other piece is, the risk side on the operations and the business side of it. Newer properties are located in newer neighborhoods, newer communities. They're generally places where people want to live, and it comes with a certain demographic and income threshold that's going to better support your business and your rent collections. So your repair and maintenance cost is going to go down. Your collections are going to go up. You're not going to run as high a bad debt. And you're just dealing with a different tenant that makes it a little easier to run your business. Now, with that comes a risk premium that you have to pay. These properties are more expensive, but what you're paying for is the lower risk. And in order to make money on investment, the first step is don't lose the principal. If you can get that out of the way, then it becomes a lot easier to make money on the principal.
Let me ask you guys, do you find that the investing appetite from limited partners has shifted or changed at all in this very crazy market cycle that we're in now? I think that we've seen a lot of unprecedented levers, over the last 24 months in this market cycle. And so, have you seen investor appetite change and move more towards, these type of quality assets? Or, do you find that the investor base is still existing from where it was before pre-pandemic, and it's just kind of a, sustaining model for you guys?
Yeah, again, I don't know. I mean, Warren can speak to his experience, but my experience having, been in this space on the, either building new assets or buying newer stabilized assets, I don't have a great point of reference to say, has there been a shift from, the more traditional 70s value add into this, kind of class A space?
I think investors probably are a little bit more wary today than they might have been 3 or 4 months ago. Just they're hearing on the news this constant thing about the Fed increasing interest rates. They're seeing a lot of volatility in the stock market. We still get a sense that there's a lot of appetite for multifamily, but I think it's natural that investors are a little bit more cautious. So I don't think it's just the newer assets that are probably gaining more attraction. I think it's the bigger markets as well. I think it's a lot easier to market a deal out of Tampa or Austin today than out of some small, tertiary market in middle America somewhere. So yeah, I do get a sense that there's a little bit of a change in investor appetite, and rightly so, because we agree with, and I think you guys as well, this kind of thesis that we should be focusing on better quality assets because it lowers your downside risk.
Yeah, and that brings up an interesting point. Interest rates are coming up, and we're all trying to judge the impact of this. But I think one of the things that people don't focus on is the bank is your biggest investor. Yeah, they're in a very secured position. They're in a low part of the capital stack. Their risk is very covered, but they're bringing the most capital to your deals. And if you look at risk-adjusted returns, the banks are giving tighter spreads and better terms on more quality assets, on assets that are well located in strong growth markets that show trends of sustainable growth, sustainable income. So if you look at the debt terms you're going to get on 1970s value add or early 2000s Class A product, it's going to be a lot cheaper, better debt.
Completely agree, and that's exactly what we've been observing as well. And it's interesting how fast the capital markets have been moving. Right, it's over the last 2 months. I mean, I feel like every single week, there's been more tightening, more contraction, more tighter terms, more expensive terms, and you've seen this very quick transition where everything that we did over the last, call it 18, 24 months was all variable rate bridge debt, debt funds. And now all of a sudden, like you see the bridge lenders backing out, debt funds are kind of putting their pencils down. And now all of a sudden you see the agencies start to come back and trying to get more competitive. And it kind of feels like we're making more of a shift towards getting back to true fundamentals is what I would say. Brian, what do you think?
I agree. This is what we're seeing in the market as well. And I think it's important for investors to look at those types of things. What type of leverage are you getting on products right now, especially on those large value add deals based on, these interest rates. And we haven't talked about interest rate caps and all these different things that are just really rocking the market right now. So definitely lots of great things that you have to be, or lots of great things going on in the market still. We're still very bullish on multifamily, especially stuff we're all talking about, the institutional, call it 1990s, 2000s and up vintage stuff with a lighter value add component, but still lots of things you got to be wary of and be cautious of in the market as well.
Yeah, absolutely. And I like that term, true fundamentals. And I think that's something, the fundamentals of real estate investment haven't changed. But I think the free money debt environment of the last 12, 24 months, allowed people to implement a high leverage strategy and, make deals pencil that wouldn't have normally penciled. But the fundamentals didn't change during that period. The debt just got really, really cheap. And allowed people to take on more risk than what they normally would have been able to.
Yeah, absolutely. You're absolutely right. And I think, we were joking about this before, right, Brian, where people were kind of living in this fantasy land, right? I mean, like you said, debt was super cheap. I mean, all of a sudden you can really go out and get super aggressive, and then you can, really it offered you a lot of flexibility in what you could do as far as acquisitions go. But in turn, though, now that you're seeing this transition or this pivot back to, more of a tightening type market, now the question becomes, okay, if I've got a 2 or 3 year bridge debt that's coming due and my capital markets are tightening up, now we're seeing, different headlines as far as inflation and what type of impact that's having on the economy as a whole. It just brings up a lot of questions about, well, hey, what's going to happen when it's time to exit or time to refinance in, years 3 through 5 or whatnot, and what does that do? So it's kind of bringing people back down to, hey, here's the reality. Here's how things really, really are supposed to be. we can't live in this fantasy world for forever. So, and it's nice. I think we were talking about this before the show as well, right? Where now you're starting to have more fluid conversations for us on the buyer side and on the seller side, right? You're seeing more negotiations coming back into conversation versus before. It's just, hey, here's your whisper. You need to go 10% over if you want to have a chance to get the deal, right? So it's good to be back in a fluid type of environment for sure.
I absolutely agreed.
Yeah. So I want to continue down this conversation if we can. Again, we love quality assets. We love, that type of product. I think historically there's been kind of a misunderstanding about, kind of the reward that you get from investing in an A-class product versus, like you said, the value add product, and I think if you rewind several years back, there was a little bit of a delta between, the upside potential from a value add versus an A-class, where, like you said, now the market has shrunk to where you're not seeing, in my opinion, you're not seeing a massive difference between the two strategies. What are you seeing, or what are you conditioning your database to expect when you're talking about investing in these type of assets? What type of holding periods, what type of return profiles are you guys realizing in investing in these institutional quality assets?
Yeah, absolutely. Again, I think it always has been a risk reward spread in these newer class A minus assets. It's lower risk. I mean, would you take an almost 100% chance of getting a 12 to 15 IRR, or do you want a 60% chance of hitting a 20 IRR on an older value adds product? But right now in this debt market and environment we have, where we've had aggressive cap rate compression over the last couple of years, and now we have rising interest rates, current yield on everything is coming in. The cash on cash return is coming down, and that's going to continue here into the near future and until rates settle down a bit. So we're seeing anywhere from kind of 5 to 7% average cash on cash over a 5-year hold. And we're targeting, anywhere from a 12 to 15 IRR, again, on a 5-year hold. And I don't think that if you're in any sort of market that has, any sort of sustainable growth, which is where a lot of people are rushing to be, again, we're trying to mitigate risk. So there's a lot of competition in these markets. I don't know that it's realistic to get much above that right now, without using a leverage strategy that probably brings more risk to the project.
I think Brian mentioned A minus at the beginning there. Like, we are looking at newer assets, but we're not at the high end luxury end of the spectrum. We really are looking for value to be added to force appreciation. It just so happens that it's on a newer asset. So our ideal property might be something that was built in the year 2000. It's 22 years old, hasn't been touched. There's probably room to start updating the kitchens, the bathrooms, some of the interiors. That's the kind of asset that we're looking at. So, he talked about 12 to 15% IRR. If we were buying something at the more luxury end, the cash on cash would probably be lower. The IRR would probably be lower. But we're trying to target that property that's somewhere in between luxury at one end and heavy value add at the other end.
Yeah. And that's, kind of, as far as this A minus strategy goes, we're really looking to be a quality product in a quality area that represents a component of affordability against the more luxury class A space, where we're still targeting that same demographic by virtue of being in that pocket of the submarket. But we're not trying to prove out top of the market rents.
That's such a great summary, and I'm really glad that you hit on that, because again, I think that's where the misunderstanding when it comes to the A-class space in particular. A lot of people, when you hear A-class, they immediately revert to the idea of it's the A++ luxury assets and whatnot. But the reality is no, that's not the case. As Warren, you mentioned, right? You could have early 2000 vintage product that hasn't been updated or renovated with today's modern finishes or specs and things like that. And as we know, demographics are all changing. We have this new younger generation that's today's renters, in this type of product. And so their expectations are much different. And then, the world is revolving around technology. And so looking at different, tech amenities and things like that. So there's still a huge value add upside potential in this space if you find, or if you're looking for, the right opportunities. Brian, I know, we have these conversations daily, right?
Yep, we like to call it the affordable A-class space.
Yeah.
We don't want to be at the top of the food chain. We don't want to be, we want to hang out in the middle, especially if you're going through economic times that are questionable, kind of like we are now, where everybody's forecasting some sort of recession. People, and we're looking at the housing market, we're seeing still a record low amount of homes for sales. You're seeing people pull out of the search for a home because of the rising interest rates. They no longer qualify. The people that previously qualified for a home that now don't because of the interest rate environment, they're not moving to a value add C-class property. They're likely moving to that B plus, A minus large community with amenities. This is exactly what we're talking about. It's that affordable A-class space. And then if there is a recession as well, and you're living in one of those luxury high rises, you're not going all the way down to a C-class either. You're going to go back down to that A minus, that B plus property that, late 90s or late 2000s, still got a lot of the things you need, but maybe it's not the luxury with the guy at the front opening the door for you, right? So I think there's still a lot of safety, which is what we're talking about: security, protecting investors' capital, protecting everybody's capital involved in this space. And I think it's a great place to be. We definitely are singing the same tune. We align with your thesis.
Yeah, absolutely. And this is why the strategy works so well. I mean, what you described is the classic, upflow, downflow B class argument. In an economic recession, people flow down from the A class to the B class. In good times, they move up from the C class to the B class. The problem with that upflow is the C class demographic comes with collection issues, repair maintenance issues. So if you bump up into this affordable A class or this A minus, you avoid that demographic exposure. You still get the benefit of this upflow, downflow. And in terms of value add, being a construction guy, the way I always look at the value add is return on cost metric. How much rent can I get for dollars spent? So if you look at these A minus, affordable A class communities, you're looking at a community that's new enough that you don't have a lot of exterior issues. You don't have a lot of infrastructure issues. Your ACs are still in good shape. Your roofs are still in good shape or on your first generation replacements. Your exteriors look good. And more importantly, the architecture is relevant. You look at the property and you don't go, oh, wow, look at these, 1970s hips roofs. Like you can't, you can dump a ton of money in your property, but you can't change the architecture and the feel of the property. So if you're new enough where you don't have to change the architecture, you don't have a lot of deferred exterior maintenance, and your amenities package is nice enough to compete with, the newer properties, then your dollars spent are just on cleaning up interiors that are mostly cosmetic updates. And your comp set is a little better. So when you look at how much rent I can get for the little dollars I have to spend on the property, that value add play works a lot better in a rising interest rate environment than, hey, I'm going to drop 20 grand a unit into this, property that's really going to look like I put a bunch of lipstick on it when I'm done. It's still fundamentally a 1970s product.
It goes back to not being able to change the demographics in an area, right? So you can drop 20K and turn a C class into an A class, so to speak.
Yeah.
But the C class property is still in a C class community, so you're still going to get top of the market C class rents, right?
Absolutely. And then again, you talk about the potential for an economic, recession. And this is a larger conversation about rent growth and how much rent growth we've seen. And, the question is, well, can we continue to see rent growth? Well, where? Incomes are what support rent growth. You can only raise rents as high as people can afford to pay. So you need to be in areas with higher incomes, with demographics that have quality jobs and jobs that aren't going anywhere. And in that C-class space, those are a lot of at-risk jobs that don't have a lot of, income growth, that can't support this rent growth at any sort of sustainable rate.
Yeah, to expand on this point here, if you go back and look at the recovery that we've seen from the pandemic, post-pandemic, at least in our markets here across Central Texas, we experienced double-digit rent growth like most of the country did. And if you really dissect that and extrapolate that data, most of that rent growth and absorption came in the A-class space, right? You had a demographic that was able to rebound, come back even stronger, and absorb most of those, rent premiums that we've experienced versus the C-class space. It was just a harder demographic, as you mentioned, to really realize that. And so I think that's something to also take into account when you're experiencing those downturns and whatnot. The recovery is so much stronger and more positive in that A-class space. And so it's just, like you said, just a stronger, more reliable demographic, of course. So, obviously these quality assets, not only does it attract, the right type of resident profile, your demographic, but it also brings the right type of capital, right? You talked about the debt, obviously the debt is more attractive to some degree on these assets, but also the type of equity partners you can bring in to these opportunities. I think we talked a little bit about the show. Tell us a little bit more about how you're structuring the equity side. And so we can expand on that if we can.
Yeah, go ahead, Warren.
So very early on, before we ever found our first deal as Equity Yield Group, we had this conversation about how we're going to fund our deals. Because we knew that if we were targeting stronger markets and newer assets, we were going to be targeting high purchase prices. So our first deal, we had to raise $11 or $12 million of equity. And as first-time syndicators, we knew that would be quite a tough challenge. So really, probably 9 months before we found that deal, we started trying to build relationships with institutional equity. We engaged a broker. They started introducing us to a number of parties. We started having conversations, looking at deals together, trying to get a better sense for what they were looking for and how that might tie into what we're trying to do. And what we found is that a lot of these institutional equity providers, they want to be in the big markets. They want to be in the newer assets. So actually we were very aligned, which was great. And that just really gave us more confidence about what we were doing. So we knew that when we could find one of these properties in a great market, we had a lot of confidence that these guys would be willing to partner with us. So that's how we put our first deal together. We ended up bringing $6.75 million, I think, from a single check writer from an institution. And that deal worked great. We're not sold on this strategy necessarily. We like to think of this as part of our arsenal. When we're putting a deal together, we're going to go and get debt. Potentially, we're going to talk to institutional equity partners, and potentially we'll go and raise the money from private investors. And every deal we'll look at on its own merits and see which individual pieces make the most sense for that deal. So we've done deals with agency debt. We've done deals with bridge debt. We've used preferred equity. We've used JV equity. We've used mezzanine debt. And really, it's great to have the flexibility and the access to the different kinds of capital. But like I said, it just comes down to the individual deal and what's going to make the most sense at that time.
And talk to us a little bit more about that decision-making process. When you say it's more specific on the deal, what does that vetting process look like to determine, okay, is this best suited for institutional equity, or do we go a different direction?
It's a complicated question, but I'll try and answer it as succinctly as possible. Every one of those instruments has advantages and disadvantages. So take preferred equity, for instance. Preferred equity wants to be paid first, and they generally want a high current payment. So they might say, well, we want to get the first 7% of money that comes out of this deal. And we've got to have a deal that's going to support us paying them 7%. Not every deal is going to have enough cash flow to support that. So if the deal doesn't have enough cash flow, immediately preferred equity is probably not the right route. The advantage of preferred equity is that they might want, say, 7% up front, but they're willing to walk away at a maximum of 11%, as an example. Now that's relatively cheap capital. So if we're looking at a deal where we want to lower our cost of capital, preferred equity actually might be a great instrument to use. It's just that there are advantages and disadvantages. And so for each of those instruments, we look at the advantages and disadvantages, the particular deal, whether it's got a lot of cash flow, whether there's merit in boosting the IRR, or lowering the cost of capital. Those are the quantitative factors. And then there are also qualitative factors as well. So if we just use debt and we don't use institutional capital, we've probably got a lot more control in the deal. As soon as you start bringing institutional partners in, there might be little bells and whistles in the agreement that change the control element, and that's a very important factor as well.
Yeah, I think it's kind of issue because I agree with you that there's definitely pros and cons with either partner or equity partner strategy. But I have to imagine there's got to be a lot of comfort, so to speak, when you have a sole equity partner that's writing you such a large, $5-10 million equity check, versus having to go syndicate that from, what we consider retail investors, right? Especially when you're looking at a 15-20 million dollar equity stack. The idea of going to syndicate that from that a large retail investor database can sometimes leave you a little bit uncomfortable, I'd imagine.
Yeah, but as an example, just a devil's advocate, it might be difficult to go out and raise 15 or $20 million from retail investors. But if we do that, at least we can control the timeline. We can see that the money's coming in and hitting our bank well before closing. One of the downsides of institutional capital is that they only bring their check on the day of closing. So it might be nice that it's a big check, but if they don't show up on that day, they leave you, out in the cold, which is a risk.
Yeah, and then that's the thing. There's no guarantee that they show up with a check. There's an entire due diligence process that they have to run to approve the check, and the contract period is usually short. We're looking anywhere from 45 to 60 days. So you don't know that they're showing up with that check till you get pretty close to the finish line.
That's where you start losing a little bit of hair and getting a little bit more gray, right?
Yeah, absolutely. But on the other side of that, these are big institutions, professional investors, and the fact that they're looking at your deal and see a lot of the same benefits that you do gives you confirmation that what you're investing in is a good risk profile and is a quality deal.
Yeah, we've kind of heard some of those stories, right, where an equity partner is backed out, our equity investors backed out call it day before closing, and that's leaving a void of $10 million of equity, and left the team scrambling, or sometimes the deal falls apart. I don't know that happens often, I guess, but it is, like you said, at a risk. It's something you need to be aware of. But like you said, these are institutional level investors. These are professional investors. I think I would hopefully safely assume that once you get to that stage of the deal cycle, that there's a pretty strong commitment at that point, because their reputation's on the line as well. And, they want to preserve that.
They're in the business of deploying money. They want to be making investments. So they have an appetite, and it goes back to understanding their appetite. They want to be investing in strong markets in the Southeast. They love large multifamily. They love A-class assets. So as long as it fits inside the box of what they want to invest in, I think you can really reduce the risk of them walking away.
Sure. Yeah, I agree. This has been something that it's so timely, guys, because this is something that Brian and I have been exploring over the last probably a couple of months, engaging with institutional level groups, very similar to this, because I think at a certain point, when you're syndicating deals from retail level investors, you obviously can maintain control. It kind of gives you a lot of flexibility, but you constantly have to be growing your database, right? You're constantly having to add new investors to your funnel, or eventually you're just going to cap out your equity source there. And so having, like you said, having an institutional partner in your back pocket, in your tool belt, so to speak, just kind of continues to give you a little bit more bandwidth and flexibility as far as your growth pattern. So that's good. Brian, any comments?
I agree with you 100%, Cody. I mean, the reality is a property that maybe you would have bought 5 years ago at $40,000 or $50,000 a door is $150,000 a door. So same property, but a much higher purchase price. And if you're getting started today, or you're newer and you're not somebody who's been doing this for 10 or 12 years with 25,000 people in your database, where you can sort of make $20 million appear overnight from $100,000 investments, it's going to be hard to acquire these very large institutional quality multifamily properties at the $150,000, $200,000, $250,000 a door. So if you want to get to that point, you're at some point going to hit that hurdle, and talking to institutional partners makes a lot of sense if you plan on scaling to that point.
Yeah, no, it's a great tool in the tool belt. It just comes down to understanding what that tool does and how it works, and it's it can be a great tool in reducing the cost of capital, and capitalizing a project. And it comes at a trade-off of control, terms, and leverage, and it's just kind of a balancing act between those properties.
Sure. I still think, we could probably expand on this a lot further, probably more than just our conversation today, talking about the pros and cons of each. But, I think going into it, knowing that, yeah, you're going to give up a little control, but you're going to have a pretty reputable equity partner that's going to help you take down these larger deals. I think it's the relationship that's the biggest long-term return, right? Where you establish that relationship, you establish that rapport, and hopefully it's kind of becomes a rinse and repeat where they want to do multiple deals with you. And then, like I said, it just accelerates your growth pattern to some degree, I'd imagine. So
I just make one point on control. I think I use that word, but in our experience, these guys are not seeking control on day one. Usually the clauses state that if you mismanage the property, they'll step in and take control. And that further reinforces the importance of professional operations. And, we talked earlier on about just great communication and making sure you're doing all the small things. So another risk for people using this type of capital is if they don't know how to operate a property professionally, maybe you are going to end up giving away control. But if you've got great operations, you've got the support staff, everything in place to make sure that you can operate a property effectively, I think there's a low risk that you're going to lose control, because these guys, they're not active operators. They don't want to actually step in. It's just that they're not going to lose their money, so they'll step in if they have to.
yeah, like you said, they just want to place investment capital and keep the velocity of money going. They don't want to be choosing paint colors or or tile colors. That they don't have time for that. They're too big for that. So definitely agree with that. So, well, guys, looking at the current environment we're in, and I know we've kind of touched base on this a little bit. Obviously we're in a very rapidly rising interest rate environment. We are seeing the credit markets tightening up a little bit, debt markets are tightening up a little bit. And I think it just further substantiates the argument to move towards better quality assets, like we mentioned before. What are you guys doing in today's cycle as far as any changes to your business, any changes to your investment strategy that maybe has kind of been a pivot for you guys over the last couple of months, if anything?
Yeah, the investment strategy as far as the products that we like to buy and where we like to buy them has remained the same. Again, kind of like we discussed earlier, the fundamentals of real estate didn't change, and we were always very much fundamental investors. We're very low risk. We avoid speculation. The thing has changed is in the debt strategy. Most deals were done with a bridge debt over the last 12 months. That's not, in our opinion, really feasible anymore. We did it. We bought very aggressive interest rate caps when we did. We've since refinanced one of those properties and sold that cap for a heavy profit. The other caps we bought are currently paying off, but now those caps aren't affordable and don't really mitigate the cost of the debt service, because you're paying the forward costs anyway. You're just paying it up front. So we've switched to looking at fixed rate, lower leverage debt to reduce the cost of capital for the project, as opposed to paying the forward interest rate.
That's exactly what we've been realizing as well, is, kind of getting back from your 70% loan to cost bridge debt to now you're getting back to, lower leverage, 55, call it 55%, 60% leverage agency debt. And then, looking to add whatever layers of equity on top of that just to kind of get the deal done. But I think you're right. I think it's good to see the agencies coming back, right? And they're way below their cap this year. I think if I'm not mistaken, less than 50% below, more than 50% below where they should be as far as their quota already this year. So we expect them to be even more aggressive going into Q3, Q4, which is it's good. It's refreshing to have them come back into the marketplace.
Yeah, and agency spreads have come in a bit. They were around 200, and we're seeing anywhere from kind of 160s to 175 spread over treasuries. But I think the important component is if you look at the forward treasury against the forward SOFR, the treasury is a lot more stable a benchmark and doesn't overreact as much as SOFR does. So there's going to be a lot of volatility in anything that's tied to the SOFR index.
Mm-hmm. Yeah, you're absolutely right. And boy, has it been volatile over the last several months, man. Especially the rate cap market and things like that. Oh gosh, it's insane. Just the volatility has just been unsettling for a lot of people. And I think you've even seen a lot of what we would consider our competitors, quote unquote, even putting their pencils down and saying, hey, we got to let this thing kind of settle down before we're ready to, be active again. So interesting times for sure, guys. Interesting time. But again, we love what you guys are doing. I definitely agree with the thesis. I mean, we're adopting a very, very similar thesis as well. So I couldn't agree more. Brian, anything that we didn't cover with Warren and Ryan that you'd like to before we close out here?
I think we hit all the main points. This is a question that I'm sure you two get pretty commonly is, how do you make any money in A class? How do you invest in A class? Why would you do that? Why wouldn't you chase the value add? I think we've done a tremendous job as a group, and y'all have done a tremendous job explaining how you can preserve your capital during these uncertain times. And that's really what this is all about, is preserving your capital. We don't want to lose any money. And then, of course, our job is to grow your capital over the life of the project as well. And these B plus, A minus institutional quality assets. There's a reason that institutions are always buying them, no matter what time of the market cycle you're in. It's because they're stable, they're risk adjusted compared to a lot of other opportunities out there. So, we align with their thesis. Hopefully, our listeners got a little bit more of an insight onto the why we're choosing these types of projects in these uncertain times, and hopefully they connect with you and connect with us if they have any other further questions about these types of projects.
Absolutely. All right, guys, before we get to our final four, I want you to whip out your crystal ball here. All right, you ready? The question that eludes everybody is, what's your forecast for the multifamily market moving forward over the next, let's call it 3 to 5 years?
Yeah, I mean, which market and where? But the question becomes, in the short term of this, rising interest rate environment, how do you buy something that's going to hold value that you can sell for more than you paid for it, when the guy who's going to buy it from you is going to have worse debt than you can get today. And that comes down to you gotta find a location that's going to have growth, and that growth of rents is going to drive the future value. So you need the incomes to sustain that growth. You need the population density and population growth to continue to put demand pressure on that market, and you need markets with barriers to entry of new supply that's going to continue to put the supply side pressure on the value. And that's really, if you look at the Southeast and in Texas and anywhere where we've had this influx of inbound migration, that's where you saw this 30% rent growth. Because with that inbound migration, most of these people, some of them are retirees, but a lot of them are employed. They're moving to places where jobs are. So in those areas, you're having the job market that's going to support this rent growth, that will support, the asset valuation in the future. You're going to need to make an exit.
Love it. Awesome. Warren, any thoughts there?
Generally, I think in the short term, we might see a little bit of a pricing correction. We're already starting to see it where deals, prices have increased so much for these assets in just the last 3 to 6 months. I think in the short term, we might see a little bit of a correction, but in the medium term, I think we're going to continue to see multifamily performing strongly, particularly for the better quality assets. I think there will be a bit of a flight to quality over that time as well.
Yeah, I think we agree with you as well, right, Brian? I think the fundamentals are still very positive. The supply demands are still very much in favor of multifamily investing, and the need is going to be there. So, and look, the liquidity and capital is still there. Yeah, certain lenders are backing out, but overall liquidity is still looking to be placed into multifamily. So I think definitely some strong wins ahead. So I think it's still a great time to buy, as long as you're smart and getting the right debt. So, well, guys, as we wrap up here, we got a final few questions for you, and then we'll call the show a wraps here. So, one thing that we like to ask all of our guests is, what do you like to do for your continued education to further your own investing? And Warren, I'll kick it over to you first.
I like to read. I read pretty widely. I've always got a list of 4 or 5 books to read and try and get through them. I don't know how many I'm reading these days, but probably 2 or 3 a month at least. And then I listen to podcasts as much as I can as well.
Awesome. Ryan?
Yeah, it's really just staying current with everything, reading any articles right now lately that have come out about monetary policy and the how they're measuring the economy and trying to forecast what's going to happen here in the future and stay ahead of things.
Awesome. Ryan, what would, if looking back at your, your timeline and your history, what was there a defining moment or inflection point in your business that really changed the trajectory of your business?
I think when you're talking about, getting into, multifamily syndication, it is really about getting, the first large deal under contract and getting into the space. There's a tremendous amount of time spent, first building the infrastructure of the business and the systems, but, then speaking with the brokers, bidding on deals, underwriting, building relationships with lenders, and then losing a ton of bids to get over that hump of kind of, winning that first deal.
Mm-hmm. About you, Warren?
I can think of two things come to mind. One is just getting out there and networking. I think, everyone talks about this being a team sport. It's a cliche, but it's so true. And as soon as I started building that network actively and surrounding myself with people who are doing deals and in the market actively, I started seeing success. The other thing that happened around the same time is mindset. I really focused on mindset and just learning about it and practicing it. And I think it makes a huge difference as well. It can be really daunting thinking that any one of us could buy a $20 million property. How in the hell could we do that when we've never done it before? But actually just having a positive frame of mind, making sure you put the team together in advance, we can do it. I mean, there's no limit to what you can do if you put your mind to it.
Absolutely. Well said. Well, Warren, what would be your single best advice for our listeners to help them grow their businesses?
I'd say focus on network. Surround yourself with the right kind of peer group. You're the average of the 5 people you spend the most time with. So make sure you're spending time with the right people, and I think that's going to pay dividends.
Absolutely. What about you, Ryan?
Yeah, one of the things I kind of figured out early on was we only have so much time, and as much as we want things to be perfect, only so much can be accomplished in the planning phase. You'll get farther faster by getting out there, doing it. It's faster to go do it, make a mistake, learn from the mistake, recover, do it correct the second time, than it is to try to lay it out on paper and then execute that paper in reality.
Yeah, it's great advice, guys. Really great advice. All right, gentlemen, tell the listeners how they can get a hold of either of you and learn more about equity yield.
The best way would be to head to our website. It's equityyieldgroup.com. And from there, you can contact us. You can jump on our mailing list. But that would be the best way of getting in touch.
Awesome. Well, Warren, Ryan, I want to thank you both for tuning in with us today. Great conversation, and wish you guys nothing but continued success.
Thanks, guys. Thanks for having us.
Yeah, thank you.